Okay, let's get into the stock market technical analysis. We're going to go through the broad charts. Drop me a thumbs up. Check out the private member group. Link in the description below. And let's get into it. Should have some volatility starting to pick up today. Maybe even before the close. We've obviously seen this huge ramp up in the tech stocks, basically the AI trade. And that for the most part, that's it. It's really just the AI trade ramping up. And I want to go through kind of those charts as well as some other things I'm kind of picking up on. I do want to point this out. We have the Fed today. Fed very likely going to cut rates by 25 basis points. Though, I mean, that's priced in. So if they cut by 25 basis points, I don't expect there really to be much of a reaction on that. They might ramp it up just briefly right after the announcement, but that would likely get sold into. So don't read too much into the price action if there's a 25 basis point cut. Now, what does the Fed say moving forward? They're probably going to say something like they're going to be data dependent. They're noticing slight softness in the labor market. They're going to justify the 25 basis point cut with something. And so that'll be that. I don't think the Fed's probably going to be really there's probably not going to be much. Now, if the Fed, for whatever reason, because it's not priced into the market, if they don't cut interest rates and they leave interest rates as is, the market will likely start to crash. So that's a possibility. The point is, if you see them if they don't cut interest rates, expect very strong downside selling. And, you could jump on board for that price action because that's likely going to continue. All right, now let's get into the charts, though, the technicals. That's really the Fed, because we also have some large cap tech earnings after the bell. This is the interest rates here, TNX, the 10-year Treasury. And I just want to cover this one theme that I'm seeing right now, and I'll go through it. We've seen interest rates rise from the, basically from the COVID lows. We had a sharp rise in the 10-year Treasury yield, and we've basically just been holding up here in this range. So the interest rates are not really moving up anymore, but they're not moving down. They're just kind of holding. And the Fed is cutting, they're signaling that they're going to cut interest rates, but that still has not really had much of a reaction on the 10-year, the long bond. So here's the last time the Fed started cutting and the rates went up. And we're basically just kind of right there, and they want to cut again. But there's no longer term, definitive reaction from what the Fed's doing. We're still kind of hanging out in this area. So bond traders, what I read on that is the bond traders are signaling that we're going to have increased inflation. We're going to have more inflation because they're not willing to what the bond traders are saying is we need at least for a 10-year we need at least 3 to 4% or 3 to 5%. It's basically range bound for these 10-year treasuries. We need that kind of yield to accommodate for the inflation that the Fed is likely going to be creating in the future. So that's what I'm reading there on the 10-year. Same with the 30-year. Same deal, really. There's your COVID rise, and rates they're not falling, but they're not really going up. They're just kind of range bound. Here's the last time the Fed cut the interest rates right here, and rates are higher since. So again, the way I have to read it is bond traders are saying, Fed, you're going to create more inflation. We need a higher yield for that. I think that theme is probably going to continue. So watch these interest rates. If the Fed cuts today and maybe signals more cuts, do the bond traders say, well, you're going to have to pay us more interest then if you're going to create more inflation? And ultimately, do we pop this 5.15% yield? We have not seen interest rates that high since 2007. So you start to pop that, and there's just gonna be a lot of pressure on debt instruments because that is basically higher interest rates. It's gonna put pressure on the market. So that's the way I'm leaning right now. I'm leaning that the bond yields spike And when they do spike, we then start to see that sell off due to rising interest rates. We'll see how the Fed goes down. But here's another thing I want to point out. DJP. This is a commodity index. This is kind of a broad-based commodity index. I looked it up right here. You'll see it's a lot of gold and copper, metals, oil, but just a broad-based kind of commodity index. I'm looking at a weekly chart here, and look what I'm seeing. This is COVID lows here, and very similar to the interest rates. All right, they're all, this is kind of a common theme. Spiked up. We then had kind of a relaxing of that, but that's you could call it a rounding bottom. You could call it a cup and handle. Regardless, this is an accumulation pattern, this big rounding bottom. So you spike up, you round, and I think it's signaling another wave higher in commodity prices. There's this potential downtrend line here. All right, so we got a reaction there, we got a reaction there, and we're basically there now. So we could pull back here because we haven't broken out. But it is an accumulation pattern that is signaling that we're likely going to see a pretty impulsive spike higher in interest rates. Okay, very similar pattern to this. I'll go and we can look at GLD, gold. All right, gold had the same pattern. Let me show you guys. See that right there? So you had the move up. It's a bigger pattern, but in general, it's kind of the same pattern. You have a strong leg up. You have this accumulation pattern. You can see here it chopped around for a little bit, creating this kind of cup and handle thing. And then you saw the impulsive move higher. So there it is. That's what I'm seeing in the commodity index. Now, it could take years to play out. There's no timeline necessarily. But let me go back to this one. Just because gold took years to play out doesn't necessarily mean that this one is. You can see it's the same pattern. Exact same. So to me, it signals that we're going to have another impulsive leg and really go test these highs here in DJP. Probably up around that 74 area. If you see commodities starting to rise, it's going to be inflationary again. We're going to see another wave of inflation. The Fed's going to have to stop their cutting cycle, and they'll come out and start talking hawkish and saying, okay, we now need to fight inflation, and we're going to raise interest rates, and they'll probably start raising. And that's kind of what we got going on. So the interest rates, the way that I'm seeing this, let me go back to the 10-year yield. The way that I'm seeing this play out is, the Fed, this was rising interest rates, all right? And then, so it was right, the Fed was on a interest rate hiking cycle, bumping those up. As the interest rates rose, then inflation eases off. And then as the Fed starts easing off on their hiking and the interest rates continue to rise again as there's inflationary pressures along with commodities, then the Fed will reverse and they'll start getting hawkish and we'll see interest rates starting to come down. So almost like the long bond, I'm seeing doing the opposite of what the Fed wants. If the Fed is cutting, then the long bond, the long interest rates rise. If the Fed is if the Fed is raising, then the long bond will fall. So they're essentially doing the opposite of what the Fed wants them to do. That's kind of how I'm seeing it play out. Whether that does work out, we'll wait to see. So going back to like wheat, because again, this one still remains one of my favorites. Here's the daily chart. You can see bullish divergence. All right, we've got bullish momentum. That's remains intact. So I haven't changed my stance on this because the technicals haven't changed. All we've been doing is just wedging within this bullish falling wedge, and we haven't broken out, so we don't have a buy signal per se. We just have this bullish pattern with bullish momentum. We got to take, once you take out this level right here, it's about 428. Lots of reactions there. You take that out, and we're there now. We're getting, probably get a little pullback there. Once you take that out, though, you're going to head to the top of the wedge, all right? And then the top of the wedge, you probably chop around a little bit at the top, and then ultimately you take that wedge out, and this thing should run, all right? It should run pretty strong. So still looks good to me. Okay, so that is that one. And then USO, oil. Haven't talked much about this because it's kind of just been dead money, similar to wheat. But this is USO. Same kind of pattern. Let me go to the weekly. You'll see here, you had falling oil and then you hit COVID. So you got that move up and then kind of this sideways price action. So it's all the same. Interest rates on the long bond, not the short end of the curve, not what the Fed's doing, but what the market's doing, what the bond traders are doing. Oil, a lot of these commodity indexes, they're all signaling that inflation, although has eased, the rate of change has eased from the 9% high. It's not dropping, all right? And there, so we have a wave up, we've got kind of a pause, and I'm thinking we're going to get another wave up. So I'm watching oil for a potential breakout. There, again, no buy signal yet. It's just we're just watching it. Okay, on to what's really just moving the market is the large cap tech stocks. And for the most part, just the AI stuff. You'll see here triple Qs, which again, triple Qs for the most part is NVIDIA at this point. So we do have to just kind of keep an eye on that. When NVIDIA falls, triple Qs will fall. Although, periodically they'll just kind of move money from one to the other. But if you get a sustained fall in NVIDIA, the other Mag 8s are going to start to fall. Triple Qs will fall. The S&P 500 will fall. It's just the mathematics of it. So triple Qs, the bigger picture is we have, we still have this like bearish rising wedge back testing that was broken. There's a big old impulsive sell signal. Still have negative divergence. That has not been negated. It remains. So technically there's no change there. And we had a big sell signal here. Now, yes, the bearish engulfing has clearly been taken out on the daily chart and the weekly. So that is no longer really intact. However, kind of some question marks going on in my mind because the thing is you ramped up here leading into large cap tech earnings and the Fed. So who's taking large positions, moving the market right ahead of these key volatility? That's kind of questionable. So we'll see if this is just kind of a stop rate that they ran right ahead of the large cap tech earnings and the Fed, and then we'll dump after that. That's kind of what I'm thinking, but we have to wait and see. Until then, for me, it's just been kind of a holding pattern this week. I'm really not doing much. I'm just kind of waiting for these events to take place, and then we'll see what the market does after that. If the market is rallying and, let's say come Friday, we've rallied, we're holding up, no real indication of a sell signal or a sell-off, then, yeah, the market's probably going to go on to have some sort of a blow-off top where it just ramps up quite a bit. Otherwise, if we are selling off, then to me, this price action right here, this gap up that we saw on Monday and, just leading into these market moving events was just a stop rate. That's the way I'm leaning because of the divergence. I'm thinking we're going to be back below here. So this is going to be, a stop rate. And maybe on earnings, all right, we might see a gap down on earnings because we gapped up. If we gap down after the earnings today or on Thursday, because those are the large cap tech days, then we have a potential for an island cluster top. Okay, just the potential. Want to point it out if we see it because I'll be talking about it if it shows up. Okay, if you're interested, Palantir, objective short today, you can see here, bearish rising wedge. It's a big wedge too. So there's the widest part of the wedge is about right there. And that gives you your measured target, which I believe to be somewhere down around, we have to line it up with some sort of a support, but somewhere down around there, about 88, we'll call it. So a big move down. And you can see here, look, we broke, drifted sideways because they held that first support at about 171. Back testing today. That's an objective short. So objective to short on a back test. Earnings coming up, obviously. And same with the large cap tech earnings. So lots can happen. But it is objective to short there. and it is also a divergent high. Let's see, the divergence is extending. So there's a new high today on the back test, a divergence into resistance. It's objective. It's a good short. Again, if this thing starts to fall and then you break support and you're down here, that's not an objective area to short. But that's when everyone's going to want to short because they'll see the price action moving down. People typically just trade with the price action, but it's not objective. The best low risk trade is right on this back test here. Doesn't guarantee it's going to work because the momentum and price is to the upside. So it's a counter trend trade. But I view this trend as broken because your bearish rising wedge was your trend, and then that trend's broken. So I like it. Here's another one, MSTR, MicroStrategy. This is Bitcoin. Bitcoin's kind of looked kind of weak recently. But here you go on the daily chart. Going back to 2023, we've got support. All right, there's another reaction. Support's broken. That's a sell signal. But we do have this little support range right here, about 280. So for me, you got to take out 280. Take that out. That's the next sell signal. And you have earnings coming up on Thursday. So anything could happen. You know, we broke down, but it's right ahead of earnings. So I'm going to wait till after earnings because they could go one of two ways. They could, you got this trend line here. If they like earnings, then they're probably going to gap it up right to resistance. And that would be the objective short. That would be could be a gap up. That's about 20% almost just up there. So I'd be looking for one of two things. One, after earnings, do we break support of 280? Or do we gap up to resistance? I want to short it here, or I want to short on a break of support. Not right now. Right now we're at support, so I don't want to short it. But definitely want to point that out. It looks like there will be a trade to be made here in the, after earnings. Just want to point this out. Kind of what's going, at least what I see is going on. There's kind of this headline pump around AI. So these companies are basically jumping on the headlines of we made a deal with OpenAI, and the market is we're seeing it kind of spiking. Where the stock spikes, and then they're selling into it. That's what's going on. So it's really hard to anticipate whether you're going to get that headline or not. But I am seeing a lot of selling pressure after you have that post-headline pop. So here's Oracle. All right, they came out with some sort of a news thing in their earnings around OpenAI. And, so it spiked up. And that was the highest, that's the high water mark essentially. This thing is down from the close of that day. It is down 16%. So that's what's actually going on. Even though it seems like, AI is this, never-ending thing, we're seeing kind of, we're seeing things sell off after they get that post-AI, post-OpenAI pump. So yeah, I'm still looking for Oracle to close the gap. All right, and I did talk about this as an objective short because look, you had the uptrend line, you broke trend, you gapped up right to resistance, you had negative divergence, everything's there in terms of the setups that I look for. There's your negative divergence into resistance after earnings. That was a short opportunity, and if you took that, you're up 15-16%, and the target would be a gap fill. All right, it's a very obvious gap, so you might not get to the full gap fill, but that would be the target. And the trade would be about 25% to the downside. So again, at the point when things seem the most bullish is actually, oftentimes the point where you either want to be selling or you want to be going the other way. This thing was up huge after that earnings report. It was up 35%. And if you were long, you'd want to be exiting your longs at that time. And if you wanted to short, you'd want to be taking short positions. That was the way to go. So that's typically the way I look for is at the point where things look the most bullish is usually the opportunity that we want to get in on the other side. Okay, that's all I have for right now. So I'm going to go ahead and get the video out, and we'll see how things play out after the Fed. All right, thanks.